We're standing at the edge of the cliff right now, not metaphorically, not as some distant warning about the future. Right now, today, the 2025-2026 economic crash isn't coming anymore. It's here. It's happening. And almost nobody realizes how bad this is going to get. Not your financial advisor, not the talking heads on CNBC, not even most economists. They're all still using the old playbooks, the old models, trying to predict this crash using patterns from 2008 or 2000. But this isn't 2008. This isn't the dot-com bubble. This is something we've never seen before, and it's going to be worse. Much, much worse. Let me show you something that should absolutely terrify you. JP Morgan, one of the most powerful financial institutions on earth, just revised their recession probability for 2025 from 60% down to 40%. Sounds good, right? Like things are getting better? Wrong. Dead wrong. What they're not telling you is that they had to revise it down because parts of the crash are already happening. The market already collapsed in April 2025. The Dow dropped 4,000 points in days. We're not predicting a crash anymore. We're living through the early stages of one. And the fact that markets temporarily bounced back, that's not recovery. That's a dead cat bounce. That's the last gasp before the real collapse begins. Here's what makes this different from anything we've ever experienced. This isn't just one bubble popping. This is 5 simultaneous crises converging at exactly the same time, each one capable of destroying the economy on its own, all of them amplifying each other, creating a perfect storm of economic destruction that makes 1929 and 2008 look like minor corrections. And I'm going to walk you through each one, show you the data, show you what's already happening, and show you exactly why experts are now saying this will be the worst economic crisis in modern history. First, let's talk about what's already happened. April 2025, the market plunged. Over 10% losses in major indices within days. The media called it a correction. They said it was just volatility related to tariff announcements. They told you it was temporary. But here's what they didn't tell you. That wasn't volatility. That was a warning shot. That was the market testing the bottom. And when the government paused tariffs and the market bounced back, everyone breathed a sigh of relief. But smart money, institutional investors, they didn't breathe easier. They got more nervous. Because they know what that bounce means. It means we haven't found the real bottom yet. It means the crash is still coming. And when it does, there won't be a government policy announcement that can stop it. Let me give you the current state of the economy right now, today, as we head into late 2025. GDP growth in the first quarter of 2025 was 1.1%. That's barely above stagnation. The long-term sustainable growth rate for the U.S. economy is around 2.2%. We're running at half that. JP Morgan is predicting 0.25% growth for the second half of 2025. 0.25%. That's not growth. That's flatline. That's an economy on life support. Morgan Stanley predicts U.S. growth will be 1.5% for all of 2025 and drop to just 1% in 2026. 1%. For context, during the 2008 recession, the economy contracted by 2.5%. So we're hovering right on the edge. One shock, one crisis, one bad quarter, and we tip into negative growth, into recession, into collapse. But it gets worse. Because while GDP is barely growing, unemployment is rising. The unemployment rate right now is 4.3%. Doesn't sound bad, right? Except it was 3.5% in 2023. It's been climbing steadily. And economists are now predicting it will hit 4.6% by mid-2026. Some forecasts say higher. Bankrate's latest survey shows economists expect job growth to slow to just 49,000 jobs per month. That's less than half the current pace. That's less than half of what we need just to keep up with population growth. Companies aren't hiring, they're cutting. Layoffs are accelerating. Tech companies that were hiring aggressively 2 years ago are now doing mass layoffs. Meta, Amazon, Google, Microsoft, all of them cutting thousands of jobs. And it's spreading beyond tech, retail, manufacturing, finance, healthcare. Everywhere you look, companies are preparing for a recession. Now, let's talk about the 5 simultaneous crises that are about to converge and destroy everything. Crisis number 1, the AI bubble. We already covered this in detail in a previous video, but I need to emphasize how critical this is. The entire stock market rally of the past 2 years has been driven by AI hype. NVIDIA alone accounts for a massive portion of S&P 500 gains. Companies are spending more on AI infrastructure than the US spent putting humans on the moon. OpenAI is losing $13 billion a year while being valued at $500 billion. This is insanity. This is fraud. And it's about to implode. When the AI bubble pops, and it will pop, NVIDIA's stock will drop 50% or more, maybe 70%. And because NVIDIA and other AI stocks have driven the entire Market, when they crash, they take everything with them. Your 401k, your retirement savings, your investments, all tied to a market that's being propped up by companies that lose billions of dollars every year. Oxford Economics just released a report saying that without tech investment, US GDP would have barely grown at all in the first half of 2025. Barely grown. The entire economy is being held up by one sector. And that sector is a bubble built on promises and hype and money that doesn't exist. Crisis number 2, the everything bubble. It's not just AI, it's everything. Housing prices have doubled in 5 years. Stock valuations are at their highest level since 2000. The Case-Shiller price-to-earnings ratio is above 40. That means investors are paying $40 for every dollar of profit a company makes. The last time it was this. High was right before the dot-com crash. Corporate debt is at all-time highs. Consumer debt is at all-time highs. Student loan debt, credit card debt, auto loans, mortgages, everything is maxed out. The average American has never been more in debt. And interest rates, which have been historically low for over a decade, are now elevated. The Federal Reserve raised rates to fight inflation, and now all that debt is getting more expensive. Companies that borrowed billions at 2% interest rates now have to refinance at 5% or 6%. They can't afford it. Consumers who could barely make payments at 3% mortgage rates are now facing 7% or 8% if they need to refinance. They can't afford it either. This is a debt bomb, and it's ticking. Crisis number 3, the commercial real estate apocalypse. This one is flying under the radar, but it's going to be catastrophic. During COVID, everyone started working from home. Companies realized they don't need massive office buildings. So now, office buildings across America are sitting empty. Vacancy rates in major cities are 20%, 30%, even 40% in some places. These buildings were financed with commercial real estate loans. Billions of dollars in loans that are now underwater because the buildings are worth less than the debt they carry. And those loans are coming due. In 2025 and 2026, over $1.5 trillion in commercial real estate debt matures. Companies have to refinance or default. Most can't refinance because the buildings aren't generating enough rent to justify the loan. So they'll default. And who holds those loans? Banks. Regional banks. The same banks that started failing in March 2023. Remember Silicon Valley Bank? Remember Signature Bank? That was just the beginning. When commercial real estate starts defaulting en masse, banks will fail. Not one or two, dozens, maybe hundreds. And when banks fail, credit freezes. Businesses can't get loans. Consumers can't get loans. The economy seizes up. This is 2008 all over again, except worse, because it's happening at the same time as everything else. Crisis number 4, the global trade war. President Trump's tariffs aren't just inconvenient. They're economically catastrophic. Tariffs are taxes. When you put a 39% tariff on Chinese goods and 10% on everything else, you're taxing American consumers and businesses. J.P. Morgan calculated this is equivalent to a $430 billion tax hike. That's money that comes out of consumer spending, out of business investment, out of economic growth. And it's not just one way. China retaliates, Europe retaliates, Mexico and Canada, our biggest trading partners, they retaliate. Now everyone is putting tariffs on everyone else. Global trade, which has been the engine of economic growth for 70 years, is collapsing. Supply chains that took decades to build are being destroyed in months. Companies can't get parts. Prices go up. Inflation surges again. McKinsey's global survey shows that nearly 70% of economists now predict a demand-led recession, where rising uncertainty and trade disruptions cause consumer confidence to collapse. When consumers stop spending because they're scared, the economy contracts. Fast, hard, completely. Crisis number 5, the sovereign debt crisis. The U.S. government owes $37 trillion. The debt-to-GDP ratio is 132%, the highest in American history outside of World War II. The annual interest payment on that debt is $1.2 trillion, more than defense spending, more than Medicare. Just interest, not paying down the debt, just servicing it, and it's growing. If interest rates stay at 5%, which they're likely to do because inflation is still above the Fed's 2% target, those interest payments will hit $1.8 trillion by 2027. That's 6% of GDP, just to pay interest on money already borrowed. This is unsustainable. Everyone knows it, but nobody wants to do anything about it because fixing it requires either massive tax increases or massive spending cuts, both of which are political suicide. So they keep borrowing, keep spending, keep printing money until the system breaks, until creditors stop buying treasury bonds, until the dollar collapses, until faith in the U.S. government's ability to pay its debts evaporates. And when that happens, it won't just be an American crisis, it will be a global crisis, because the entire world economy is built on the assumption that U.S. treasury bonds are safe, that the dollar is stable, that America pays its debts. If that assumption breaks, everything breaks. Now let me show you why this crash will be worse than 1929 and 2008 combined. In 1929, the crash was primarily a stock market bubble bursting. Banks failed, businesses closed, unemployment hit 25%. It was devastating. But the economy was less interconnected than today. Most people weren't invested in stocks. Most businesses weren't dependent on global supply chains. Recovery took a decade, but the structure of the economy remained largely intact. In 2008, the crash was a housing and banking crisis. Subprime mortgages, derivatives, credit default swaps. The financial system nearly collapsed. The government had to bail out banks. Unemployment hit 10%. Millions lost their homes. But again, while devastating, it was primarily a financial sector crisis. The real economy, manufacturing, services, retail, those took a hit, but survived. And the government had tools to respond. They could lower interest rates to zero. They could print trillions in stimulus. They could bail out banks and car companies. Those tools worked. Not perfectly, not fairly, but they stabilized the system. This time is different. This time, it's not just one sector, it's everything. It's stocks, it's housing, it's commercial real estate, it's corporate debt, it's consumer debt, it's government debt, it's global trade, it's technology valuations, it's geopolitical instability, all of it happening simultaneously. And here's the killer. The government doesn't have the tools to fix it this time. Interest rates are already elevated. If they cut rates to zero again, inflation will spiral out of control. If they keep rates high, the economy contracts faster. They can't win. They're trapped. Stimulus? The government is already running trillion-dollar deficits. There's no room for massive stimulus without triggering a sovereign debt crisis. Bailouts? After 2008, the public made it clear they won't tolerate another massive bank bailout. Politicians know it's political death to hand taxpayer money to failing banks again. So what happens when banks start failing this time? Nothing. They fail. They close. Deposits get wiped out above FDIC limits. Businesses lose access to credit. The economy grinds to a halt. And the psychological factor. This is what most people miss. Crashes aren't just about numbers and balance sheets. They're about fear, confidence, trust. In 1929, people didn't have instant access to information. News traveled slowly. In 2008, we had 24-hour news, but social media was still new. Now we have instant, real-time information. Every market move, every job loss, every bank failure, every bad economic report. Broadcast instantly to billions of people. Fear spreads faster than ever before. And when fear takes hold, when people panic, they stop spending. They hoard cash. They pull money out of banks. They sell stocks. And that selling triggers more selling. That fear spreads more fear. It becomes self-fulfilling, a death spiral. And once it starts, once that psychological tipping point is crossed, there's no stopping it. The crash becomes inevitable. Let me walk you through what the timeline looks like. We're in late 2025 right now. The warning signs are everywhere. GDP growth anemic, unemployment rising, stock markets volatile, banks stressed. But most people still think we'll avoid recession. They think the Fed will cut rates and fix everything. They think Trump's policies will boost growth. They think it'll all work out. It won't. Here's what's coming. Fourth quarter. 22-25 into first quarter 2026, we're going to see accelerating job losses. Tech layoffs will spread to other sectors. Consumer spending will drop as people get scared. Holiday sales in late 2025 will disappoint. Companies will miss earnings. Stock prices will start falling. Not dramatically at first, just steady declines. Down 2%, up 1%, down 3%, up 1%, grinding lower, testing support levels, breaking through them. Second quarter 2026, the dam breaks. A major bank fails, probably a regional bank with heavy commercial real estate exposure. The government tries to arrange a rescue merger, but it doesn't work. FDIC has to step in. Depositors panic. Bank runs start. Not physical bank runs, digital bank runs. People move money from smaller banks to bigger banks. But bigger banks are stressed too. Credit markets freeze. Companies can't roll over debt. Defaults accelerate. More banks fail. The Federal Reserve has to make a choice. Cut rates aggressively to save banks, or keep rates high to fight inflation. They choose to cut. Rates drop from 5% to 3%, maybe even 2%. But it's too late. The damage is done. Businesses have already laid off millions. Consumers have already stopped spending. GDP goes negative. We're officially in recession. Third quarter 2026, the contagion goes global. The US recession triggers recessions in Europe, Asia, Latin America. Global GDP, which Morgan Stanley predicts will be 2.9% in 2025, drops to 1.7% or lower in 2026. Some countries enter depression. Currencies collapse, governments fall, civil unrest, protests, riots. The fragile post-pandemic global order breaks down. In the US, unemployment hits 8%, 9%, maybe 10%. Stock markets are down 40% from peaks. Housing prices start falling. Not everywhere, not immediately. But in overpriced markets and bubble markets, prices drop 20%, 30%, 40%. Foreclosures rise, bankruptcies surge, middle-class wealth stored in homes and 401ks evaporates. Life savings gone, retirement plans destroyed. The American dream dead. Fourth quarter 2026 into 2027, we enter the depression phase, not recession. Depression. The economy contracts 5%, 7%, maybe more. Unemployment hits Great Depression levels, 15%, 20%, possibly 25%. 1 in 4 workers without a job. Soup kitchens reopen. Homelessness explodes, crime surges, cities become dangerous, the social fabric tears. And politically, this level of economic devastation will trigger massive political upheaval. Populist movements, both left and right, will surge. People will demand radical change. They'll elect politicians promising revolution. Socialism, nationalism, authoritarianism, whatever they think will fix things. And those politicians, whether well-intentioned or not, will make things worse. Price controls, trade barriers, wealth confiscation, capital controls, policies that sound good but destroy what's left of the economy. This is how democracies die, not with a bang, with an economic collapse that makes people desperate enough to give up freedom for security. But here's what makes this even worse than 1929 or 2008, the level of global interconnection. In 1929, if America crashed, most of the world kept functioning. In 2008, we had globalization, but it wasn't total. This time, the entire global economy is so interconnected that when one major economy fails, everyone fails. China's economy is dependent on U.S. consumer spending. Europe's economy is dependent on both. Emerging markets are dependent on all of them. When the U.S. crashes, China crashes. When China crashes, everyone crashes. There's no escape, no safe haven, nowhere to hide. The technology factor, our entire economy now runs on just-in-time digital systems. Everything is optimized for efficiency, which means there's zero buffer, zero margin for error. One disruption, one failure cascades instantly. The 2008 crisis took months to fully develop. This one will take weeks, maybe days, because everything is connected digitally. When one bank fails, the algorithms notice, the trading algorithms sell, the risk management algorithms sell. Human traders panic and sell. It all happens in microseconds. Flash crashes that used to be rare will become common. Circuit breakers, trading halts will trigger daily. Markets will be in constant chaos. And when people lose faith in markets, when they believe the system is rigged or broken or collapsing, they pull out entirely. Retail investors, pension funds, foreign governments, everyone exits at once. And when everyone tries to exit at once, there are no buyers. Prices don't fall gradually. They crater, collapse, vanish. The political deadlock. In 1933, Franklin Roosevelt had a mandate. Congress gave him power to act. He implemented the New Deal, good or bad, at least he could act. In 2008, even with partisan gridlock, Congress passed TARP. They did something. But now the political system is completely paralyzed. Democrats and Republicans can't agree on anything. The country is more divided than any time since the Civil War. When this crisis hits, when action is needed immediately, Congress will spend months arguing, months, while the economy burns. While people lose everything, politicians will point fingers, blame each other, hold hearings, give speeches, but do nothing. Or worse, do things that actively make it worse because they're playing to their base instead of solving the problem, the social media amplification of panic. We've never had a major economic crisis in the age of TikTok, Twitter, Instagram, real-time information overload. When things start going bad, videos of bank runs will go viral. Stories of layoffs will trend. Everyone will have a hot take, a prediction, a theory. Most of it wrong, most of it fear-mongering. But it doesn't matter if it's accurate. It matters that it spreads, that it amplifies fear, that it makes everyone more scared. And scared people make irrational decisions. They sell everything. They hoard cash and food. They stop spending entirely. And that collective irrational behavior based on fear and misinformation will make the crash so much worse than it would have been otherwise. So what do you do? How do you prepare? Because that's the real question. Knowing this is coming doesn't help if you don't act. First, understand that traditional advice might not work this time. Financial advisors will tell you to diversify. Hold a mix of stocks and bonds. Stay invested. Don't panic. That advice worked in 2008 because markets recovered relatively quickly. It might not work this time. If we're heading into a decade-long depression, holding stocks for 10 years could mean watching your portfolio never recover. Bonds. If inflation surges or the government faces a debt crisis, bonds will be worthless. Cash. Cash might hold value, but only if you have it physically. If banks fail and you can't access your money, digital cash doesn't help. Here's what you should actually consider. 1. Reduce debt aggressively. If you have variable rate debt, pay it off or refinance to fixed rate now. If you have credit card debt, car loans, anything with high interest, eliminate it. Because in a depression, income drops, but debt payments don't. Being debt-free is the single most important thing you can do. 2, build cash reserves. Not just 3 months of expenses, 6 months, a year if possible. Physical cash, not just money in a bank account. Because if banks fail, ATMs stop working. If the grid goes down, digital money is inaccessible. Having physical currency matters. 3, diversify beyond traditional assets, gold and silver. Physical precious metals that you control. Not ETFs, not paper gold, physical coins and bars. Because throughout history, when fiat currencies collapse, precious metals hold value. They're insurance. 4, develop multiple income streams. If you rely on one job, one source of income, you're vulnerable. Side businesses, freelance work, anything that diversifies your income, so if one source disappears, you still have others. 5, invest in skills and relationships. In a depression, what matters isn't how much money you have in the bank. It's what you know and who you know. Skills that are valuable in a crisis. Medical skills, repair skills, farming, carpentry, anything practical, and relationships. Communities survive crises together. Build networks of people you trust. Because when systems fail, informal networks become essential. 6, consider geographic diversification. If you live in an expensive city that's dependent on one industry, you're at risk. If tech collapses, Silicon Valley becomes a nightmare. If finance collapses, New York becomes dangerous. Having the option to move, to go somewhere more stable, more affordable, that's valuable. 7, prepare for breakdown of services. What happens if supply chains fail? If grocery stores can't stock shelves, if power becomes unreliable? Having some basic preparedness, stored food, water filtration, backup power, this isn't crazy prepper stuff. It's rational insurance when facing systemic risk. Most importantly, prepare psychologically. This is going to be hard. Watching everything crash. Watching people lose their jobs, their homes, their savings. Watching the government fail to fix it. Watching society become more unstable. It's going to be traumatic. People will become depressed, anxious, angry. Some will give up. Some will lash out. You need to maintain your mental stability, your sense of purpose, your ability to think clearly and make good decisions, even when everything is chaos. That mental resilience will be more valuable than money. The 2025-2026 crash is coming. It's not a question of if. It's a question of when and how bad. All the indicators are flashing red. All the experts who predicted previous crashes are warning about this one. The only difference between now and then is that now you've been warned. Now you have time to prepare. Not much time. Months, maybe a year at most. But enough time to protect yourself and your family if you act immediately. Most people won't. They'll ignore the warnings. They'll think it won't be that bad. They'll trust that the government will fix it. They'll keep living their lives as if everything is fine until one day it isn't, until their bank fails, until they lose their job, until their savings evaporate. And then they'll panic. Then they'll wish they had prepared. Don't be most people. The storm is coming. You can see it on the horizon. The clouds gathering, the wind picking up, the temperature dropping. You can feel it in the air. Something bad is about to happen. And when it does, when the full force of this economic hurricane hits, it will destroy everything in its path. The only question is whether you'll be ready, whether you'll have done what needed to be done, whether you'll have built the shelter strong enough to survive. This is your warning. This is your chance. Use it wisely, or don't. But don't say you weren't told, because when this is over, when we're picking up the pieces in 2027 or 2028, looking back at how we got here, this moment right now, this will be the moment people wish they had acted. The moment they had a choice, before the crash became inevitable, before the depression became reality, before everything changed forever. The 2025-2026 crash will be worse than 1929 and 2008 combined. Not because I say so, because the math says so, because the warning signs are everywhere, because the perfect storm of simultaneous crises has never happened before, and because this time we don't have the tools to fix it. This time, when it breaks, it stays broken for years, maybe decades. This is the big one, and it's already begun.